Right then. Let's slow this right down. This isn't something you skim. It's not background noise. And it's definitely not hype. This is one of those conversations that only makes sense after it's already started affecting you. We're talking about the UK housing market. Not headlines. Not panic posts. Not clickbait predictions. Just what's actually happening. Quietly. Bit by bit. While most people carry on as normal. This is the biggest housing bubble in UK history. Not as an opinion. Not as a hot take. In scale. In debt. In exposure. And the uncomfortable truth is, it's not cooling off. It's imploding. Now hang on. That doesn't mean chaos tomorrow. No bank queues. No overnight collapse. That's not how housing bubbles end. They don't explode. They crack. They leak. They pretend everything's fine. Then suddenly, everyone realizes at once. Let's rewind. For decades, we heard the same message. Property always goes up. Bricks and mortar are safe. Just get on the ladder. And to be fair, worked. Prices rose. Equity built. People felt sorted. Confidence grew. Then confidence turned into certainty. And certainty is where danger hides. Because once people believe something cannot fail, they stop questioning it. They borrow more. Stretch further. Assume tomorrow will fix today. The first warning sign wasn't prices falling. It was silence. Homes stopped selling. Not crashing. Not collapsing. Just sitting. Viewings slowed. Offers vanished. Estate agents stayed upbeat. But phones stopped ringing. Weeks passed. Then months. Then sellers started saying things like, "It only takes one buyer. We're not desperate. We'll just wait." Markets don't care about patience. They care about demand. And demand was quietly disappearing. Instead of cutting prices properly, instead of accepting reality, listings began to vanish. Not sold. Not withdrawn with explanations. Just gone. Quietly removed. That's not normal. That's fear. When a market hides supply, it's trying to protect confidence. Because once buyers see how many homes aren't selling, they step back. And buyers stepping back is deadly for housing. Because housing relies on belief. Belief that prices hold. Belief that demand exists. Belief that tomorrow's buyer will pay more. Once belief cracks, prices follow. Now let's talk about something dull-sounding, but life-changing. Negative equity. If you've never experienced it, count yourself lucky. Because it's not just numbers. It's a trap. Negative equity means you owe more than your home is worth. So selling doesn't solve anything. You sell the house and still owe the bank money. That's rough, and it changes how people live. You stop thinking about moving. Stop upgrading. Stop making plans. You feel stuck. Because you are. This isn't rare anymore. It didn't hit one group. And stop. It started with peak buyers. Then spread. Every small price drop pulls more households underwater. Quietly. Some people haven't even checked yet. They still think they've got equity. But equity only exists if someone will pay that price. And right now, buyers aren't paying. Now let's talk geography. Because this isn't one city. It's not just London. Not just the southeast. It's happening everywhere. Some areas are already down properly. Not tiny dips. Proper drops. Tens of thousands gone. In some places, even more. And here's the worrying bit. It's happening at the same time. Across the country. That's rare. That's dangerous. People keep saying, it'll bounce back. Hang on though. Bounce back needs demand. In the past, population growth helped. More people. More buyers. This time, it's different. People are leaving. Others can't afford to buy. And many newcomers aren't buyers. So when prices fall now, there's no solid floor. Prices don't bounce. They reset. And they stay there. Longer than people expect. Let's pause here. Because this is the point. Where most people still say, yeah, but it'll be alright. This is where denial lives. And this is where part 2 begins. Because next, we need to talk about builders, mortgages, and why the slow part is actually worse. Right then, this is where things start to feel a bit heavier. Because once prices stop bouncing, everything underneath starts creaking. And the next layer you need to understand is the builders. Not what they say, but what they are doing. House builders don't shout when they are worried. They don't hold press conferences. They change behavior, quietly. And right now, their behavior is cautious, borderline nervous. Big developers are saying costs are too high. Materials cost more. Labor costs more. Finance costs more. But prices can't keep up. Margins are getting squeezed. So instead of expanding, they pull back. You can see it on sites. Half-empty developments. Minimal workers. Long gaps between stages. Not stopped, just slowed. Dragged out. Why? Because finishing homes means selling them. And selling now means locking in losses. So they wait. They delay. They hope conditions improve. That's not confidence. That's survival mode, mate. You've probably noticed the incentives. Big discounts. Stamp duty paid. Free upgrades. Some offers look generous. Almost tempting. But here's the thing. In a strong market, you don't need incentives. Buyers queue up. When incentives explode, demand is weak. Now here's something that really matters. In some places, new builds are cheaper than older houses. That's backwards. New homes should cost more. They are new, more efficient, higher spec. When they don't, pricing logic breaks. And once pricing logic breaks, markets become unstable. Because buyers stop trusting prices. They hesitate. They wait. And hesitation kills momentum. Now let's talk mortgages. Because this is where things get personal. Very personal. For years, cheap mortgages carried everything. Low rates made high prices look affordable. People stretched themselves. But payments felt manageable. So borrowing kept growing. Now fast forward. Those cheap deals are ending. And this next bit explains why 2025 matters so much. In 2025, millions of fixed-rate mortgages reset. Cheap deals end. Rates jump. Monthly payments rise. For some households, by hundreds. For others, over $1,000. That's a shock. Here's the catch though. Many people won't qualify for new deals. Affordability rules are tighter now. Banks are stricter. Stress tests are harsher. So even if you've paid on time, you might not pass. That leaves people stuck. Higher rates. Higher payments. No escape. Month after month. This isn't a sudden crash. It's erosion. Relentless. Psychologically draining. People cut spending. Holidays go first. Then cars. Then everything else. That ripples outward. Now let's talk about wealth. Or what people thought was wealth. For years, UK middle-class wealth was built on property. Not salaries. Not savings. Property. Homes became pensions. Equity became security. People planned retirements around house values, inheritance plans, around future prices. All of it relied on one belief. Property always rises. Now that belief is cracking. And when belief cracks, behavior changes. People stop spending. Stop upgrading kitchens. Stop taking risks. They hunker down. And when millions hunker down, the economy slows. Quietly. Not dramatically. International investors see this already. Big money doesn't wait around. They sell early. Even at losses. Because losing 15% now beats losing 40 later. That's not panic. That's calculation. Some investors aren't just selling. They are betting against the market. That should tell you something. People often ask, won't the government fix this? Let's be honest. Options are limited. Cut rates. Inflation flares. Raise rates. Housing takes more pain. Spend money. Grows. Every lever hurts something. So instead, We get delays, soft language, temporary fixes, nothing structural, nothing that changes the maths. Now here's the human side. Because numbers don't show stress, people do. You can already feel it. More anxiety, more pressure. People trapped in homes they can't afford and can't sell. When whole towns are underwater together, everything freezes. No spending, no movement, no upgrades. Local economies stall quietly. And that's dangerous. Because slow damage is harder to see. People stay hopeful too long. They deny. They wait. They assume recovery. Until suddenly, reality hits. And this is where part 3 begins. Because next, we need to talk about what happens socially, who survives, and what the real bottom actually looks like. Right then, this is the part most people avoid thinking about. Not because it's dramatic, but because it's uncomfortable. Because now we're not talking about charts. We're talking about real life. When housing slows like this, it doesn't just hit prices. It hits behavior. It hits confidence. And eventually, it hits society. Let's start with movement. Or rather, the lack of it. When people fall into negative equity, they stop moving. Not just houses. Lives. You don't move for a new job. You don't downsize. You don't relocate. You stay put. Even if it's not ideal. Even if it's stressful. Even if it's holding you back. When thousands of people do that at once, local economies freeze. Fewer people moving means less spending on furniture, less renovation work, less local trade. Builders feel it. Trades feel it. Shops feel it. Quietly. And this doesn't show up in headlines straight away. It shows up as a slow dull ache. Businesses closing one by one. High streets thinning out. Opportunity drying up. Now let's talk about stress. Because housing stress isn't just financial. It's emotional. When your biggest asset starts losing value, and your biggest debt stays the same, that pressure builds. People cut back, then cut back again. Arguments start. Sleep suffers. Mental health takes a hit. And the worst part? You can't escape it. Because the house you want to leave is the thing trapping you. This is why housing downturns feel different from other recessions. You can't walk away easily. You live inside the problem. Now think about scale. This isn't a handful of households. This is whole towns. Whole age groups. Entire generations who bought late. When that many people are under pressure at once, it changes social behavior. People delay kids, delay marriages, delay life decisions. Because uncertainty kills confidence. You can already see it. Fewer people starting families. More people staying put. More people feeling stuck. This isn't panic. It's stagnation. And stagnation lasts longer than crashes. Now let's talk about government. Because people always ask, surely they'll step in. The truth? They are stuck too. They can't slash rates freely. That risks inflation and currency issues. They can't hike rates aggressively. That crushes housing faster. They can't spend big. Debt's already high. Every option has consequences. So what do governments do? When all options are bad, they delay. They soften language. They buy time. Time doesn't fix housing maths. It just spreads the pain out. Now let's talk about investors again. Because this part matters. The smartest money in the room doesn't wait for confirmation. They move early. Quietly. When institutions sell property, they don't announce it loudly. They exit in pieces. They accept losses. They move on. And when they do that, it's because the upside's gone. Not because they are scared. Because the reward no longer justifies the risk. Retail buyers tend to do the opposite. They wait. They hope. They tell themselves, things will turn around. By the time the average person realizes, the exit's already crowded. Now let's address the big question. Where is the bottom? The bottom isn't when prices fall a bit. It's not when headlines say, recovery. It's not when estate agents get optimistic again. The real bottom comes when normal people can afford homes. Teachers, nurses, young families, people buying without stretching every last penny. When mortgage payments feel manageable again. When people aren't terrified of interest rates moving. We're not there. Not even close. This doesn't mean prices collapse forever. It means they reset lower and stay there longer than people expect. Some people will be fine. Those who bought early. Those with low debt. Those with flexibility. Others will struggle. Those who bought late. Those who stretched. Those with little margin. That's not judgment. That's just maths. And here's the hardest part to accept. Most damage happens before people emotionally accept it. People stay hopeful. They tell themselves, this is temporary. They delay decisions. They wait for recovery. And waiting too long is often the most expensive choice. This doesn't mean panic. It means realism. If you're a homeowner, understanding your position matters. Not emotionally, financially. If you're a buyer, patience is power. Waiting costs nothing. Rushing costs years. If you're watching from the sidelines, understanding this cycle puts you ahead of most people. Because housing cycles don't reward emotion. They reward timing. So let's be very clear. This isn't a collapse tomorrow. It's not chaos. It's not drama. It's a long unwinding of a belief system that lasted decades. A belief that property only goes one way. A belief that leverage has no downside. A belief that tomorrow will always fix today. That belief is cracking. And like every bubble in history, it happens slowly at first, then faster, then all at once. So yeah, the biggest housing bubble in UK history isn't deflating, it's cracking. Right then, that's the full picture. No hype, no fear, just reality. If you've listened this far, you're already ahead of most people. And that alone is worth more than any headline.